All right, welcome. My name is Dominic Danino, aka Mr. Rent-to-Own Homes, and on this week's episode of the Mr. Rent-to-Own Homes show, we're going to be talking about new construction and is rent-to-own an option on new construction. So, I am joined by James Brown, real estate investor agent in Colorado. So, welcome back, James.
Thank you, sir.
Cool. So we've talked about this, and this comes up as a matter of fact when I did my last presentation last week at one of our title companies. One of the agents asked about this specific item, right? So what do you say when somebody says, "Hey, can you guys do new construction on rent to own?"
Absolutely. Yeah, we
All
can
right.
do it.
You wanna touch on that, and then I'll talk about the new construction as well with that. But I'll let you go first.
Yeah. I mean, new construction is ideal, really, because we don't have to make any repairs or worry about anything like that. Of course, there's different grades of builders and quality, and there can be some things come up, but it's not a distressed property that needs a bunch of work, which is what we typically avoid. So, and as long as the purchase price isn't, way out of whack, cookie cutter, new construction homes, 3-bedroom, 2-bath, something like that. That's a good fit.
Yeah. Some people may not realize this though, and depending on your market and depending on the builder, some builders do not sell to investors. So that is a caveat that I have out here. Is hey, is the builder open to selling to an investor? Because some builders will not sell to investors. As a matter of fact, there was a builder that said, "Hey, we will sell to an investor, but as long as we only have one investor at a time in the process." So,
yeah, that is a challenge,
right? So let's say you had an investor and they bought a new build and they just kind of, I don't know, say, "Hey, I'm going to put a deposit on the lot, no foundation built yet, no frame, no nothing. I'm going to put a deposit on the lot," and that takes, I don't know, 9 months, 12 months, 18 months, however long it takes to build it. That one investor is going to hold up any new investors coming through, right? Because they're saying, "Hey, we only do one investor at a time until it closes," which is, I get it, but seems a little preposterous, but it is what it is, right? They have their own rules and they're funny about that. Two, when it comes to being an investor, second part is a lot of these builders want you to go through their lender, right? So we don't use their lender for our process.
Right.
So if they insist that, hey, it has to go through my lender, then I guess it's not going to work, right? One, because their lenders tend to be pretty in the box. They don't do anything creatively. They want conforming, conventional FHA. They don't do anything that's out of the box where somebody could, hey, I'm self-employed and I only have bank statements. They don't do any non-QM. They don't do a non-QM loans. They don't do DSCR loans, right, for investors. So these builders want you to use their lender. So that's a caveat that sometimes we can't do anything with. Two, about investor concentration or how many investors or if they even sell to an investor. And then the other one is timelines too, right? So what we're looking for is we're looking for spec homes, right? Stuff that can close within 30 to 45 days, right? Because let's just walk through an example. Let's say, hey, somebody says, "Hey, I don't qualify for traditional loan. Can you do rent-to-own homes on a new build?" Said, "Yeah, okay. How long is it gonna? What are you looking at?" It's like, "Well, we want to pick out this lot, and it's gonna take 9 months, 12 months, 18 months to build, and that's a no-no, not for us, right?" And the reason being is, let's just kind of walk through this. Let's say we put up earnest money, and we locked up that property or that lot while it's getting built. So the builder takes a deposit, right? They're going to take a deposit, and it's non-refundable. So if this individual, this tenant buyer, or the individual that wants to rent to own, wants that property, in that whole period of time while this property is being built, life changes happen, right? They could get divorced, they could lose their job, they could quit their job, they could just move out of state, they could get hit by a bus, right? And who's out that money?
Yeah,
right?
And we're on the hook. Yeah,
We're on the hook, right?
Yeah.
Now, if somebody's willing to put up their own money, I guess, but they got to realize, hey, you put up the money. If you ghost us, you walk away, you don't perform, then it's your money. That's it, right? I guess if somebody's willing to do that, generally we don't want to play that game because, like I said, there's too many things that could happen.
Yeah.
Right. So we're looking for spec homes. Also, the other aspect of new construction is typically they offer you upgrades on new construction, right? So they give you the base model and they give you what the base features has, right? So it's a particular either carpet, tile, or cabinetry, or countertops, or whatever that may be, right? So they're gonna have the base one, and then if you want upgrades to that, the builder says, we'll give you the upgrades. The upgrades cost this much and this much and this much and this much. If you want those upgrades, you're going to have to give us a deposit towards those upgrades, because if we do that work for you and you disappear, well, we already out that money to do those upgrades, and that may not be something that somebody else wants. You may want the purple ones and nobody else is going to want them, but you walked away. They're stuck with a new build with the purple countertops or whatever that may be, right? So they're going to want a deposit on those upgrades, and we won't be the ones putting up the money on those upgrades. Somebody has the wherewithal and the money to say, hey, I'll put up the money on the upgrades. I'll put up the money, the deposit on the timeline. Then okay, we can have that conversation, right? Yep. As long as you realize, hey, you're putting up the money, and if you walk away, it doesn't follow through, it doesn't happen, then that's on you, right? As the buyer in that transaction. So that's really the reason why we prefer, if it's got to be a spec, because there's just more people that are going to fit into that, right? And typically somebody comes, we do have some people that have more than the minimum, so potentially they could have the means to go ahead and put the additional funds that's required for that, right? Yep. That's in addition to what they got to do with us to secure the property through us on our program, right? So in addition, right? So it's not part of, it's in addition to. Let me talk about this, and some people not realize, and I like to explain this during my presentation as to why is it that builders don't like to sell to investors, right? So what's been your experience with that?
I think they want owner occupants, not renters in that area. That's kind of the main thing. Yeah, right. So one of it is control. Two, when you have builders, they tend to be in PUDs, right? Or PUDs or HOA, for people that don't know that means, is planned unit developments, right? Where where they have a shared pool and shared courtyard, and there's a HOA that's maintaining this to keep the look of the whole neighborhood or the block or the subdivision looking a certain way, right? So that's why the PUDs or HOAs are created, to kind of make sure that people don't have refrigerators or cars on blocks out in the front yard, or people are doing car repairs and overhauling an engine in the driveway and got stuff all over the place and whatnot, right? So that's usually the reason, is to kind of keep an appearance on the property's neighborhood and maintain values, right? So I know we like to beat up HOAs, right? And I'm not a big fan either, right? But there is a purpose. It's just how they manage and how they do it, right? So I think maybe some of these people have gone too far with it and how much control they want and so forth, right? So right now that's kind of very contentious these days, right? People against HOAs and that reason. But the initial thought with it was, when these things were created, was for that purpose, is to maintain values and appearances of the neighborhood, so that way you don't have random people doing crazy stuff
and impacting the values of other people's homes in that neighborhood. Right?
Yeah.
That's really the bottom line with it, right?
Yeah. That was my old house. It would have been nice to have
Yeah.
an HOA to kind of keep my neighbors in control, because it was that cars on blocks, appliances in the backyard, trailer, just all of the things.
Yeah, and you drive around neighborhoods, and I mean, everybody out there drives around neighborhoods, and you think, oh my God, okay, this is a nice house. They kept it nice and neat, right? So they talk about the pride of ownership, nice and neat. The yard is nice and clean, everything. And then next to it, you got the people that are just kind of like, no, it's Sanford and Sons, right? They got the right. They're collecting all the junk, right? They got it's a junk collecting lot,
Yeah.
right? So that's just brutal, right? I mean,
Yeah.
and I know people want to live how they want to live, right? But it just doesn't help. So if a builder has a subdivision and to the first person that they sell, it's one of these people, well, they're going to have a hard time selling the rest of the subdivision, because people driving through is like, oh my God, I don't want to live next to that person. Nobody wants to live in this neighborhood, right? So that's why they want that kind of control.
Yeah. Somebody with pride of ownership.
Yeah. I mean, that's the concept of it, right? So there's a fine line of going overboard with it and so forth, right? And then the other part was just builders in general, right? So they got burned during the financial crisis back in 2007, 2008. If you were in one of those areas, which we had here in the Phoenix market, where we had a lot of new builds being built out by builders and subdivisions, and during the financial crisis, people were speculating and being investors. They're buying the property or buying the lot, getting it at one price while it was being built out, but they never intended to occupy those properties, right? And what happened was, by the time it was built, they would sell it on the market, and as the values had been going up, they would just sell it at the higher price and basically became a flip for them, right? So then it's a flip, right? Yeah. They just weren't doing the construction; it was the builder that was doing all the work, right? And so they flipped it in for a profit. But unfortunately, right, it worked for some people, and some people kept on going, and then some people just said, "Hey, I'm going to take my profit this one time." But what happened was, it became a game of musical chairs. Who was the last sucker at the top?
Mm-hmm.
Right? And since these people never intended to own it, they never closed. Or if they did close and couldn't find somebody to buy it on the flip side, they just let them go, because they weren't going to live in them. They already had a primary, right? They said, "Oh yeah, I'm going to move into it," but really they didn't.
Yep.
Right.
So
that's what happened. And so the builders got stuck with all these houses. And now, if you think about it, if you have a subdivision with, let's say, 50 houses in them, and the majority of those houses were bought by investors that never moved in or never intended to move in, or weren't able to find a buyer to occupy them. Now you had these subdivisions that say, out of these 50 houses, maybe 5 to 10 people were owner occupants, and then the rest were empty. They were vacant. What do you think that does to values? Right?
Yeah,
those started getting foreclosed on and taken back, and they became REOs, and all those became REOs. The problem with that is, when you have an HOA or a PUD where everybody pays a monthly amount for either the shared community, the clubhouse, the pool, the grass, the courtyards, whatever, I don't know, the tennis court, whatever that may be, right? Everybody shares into that. And when the HOA management companies, they're expecting so much money to come in from all the owners to pool that money so they can pay the bills and maintain it, and the water that's needed, and the pool guy that's got to come, and the landscaper that's got to do the grass cutting. Well, if there's so much money that's needed, so let's say for the 50 people that are supposed to be living in it, or the 50 owner occupants or owners of that are pulling into that money, there's only 10 of them. Well, there's a shortage, right? Who's coming out of pocket with that? The HOA property management company doesn't come out of pocket. They just manage it. They're not the owners. They're not going to contribute and say, "Oh, we'll put it in and we're going to come out of pocket," right? There's no profit in that, right? They collect the fee just to do the management, but they're not owners. So if there's a shortage, what ends up happening is they do special assessments to the people that are left. Well, if you got into one and you're one of the 10 and your HOA says, oh, I was supposed to be $100. Well, now you got to make up the difference for all the other 40 people that aren't contributing. Now you're in trouble because now your assessment goes up. It's either one lump sum or your monthly amount went up from $100 to $500 or $1,000, and you barely qualify for the house or whatever, or it's not in your budget. Even if you had it in your budget, you don't want to be doing that, right? You don't want to be paying towards everybody else's, right? So now you start to have these issues. Now these private companies and HOAs say, we don't have the funds and you don't want to pay it. Well, we're just going to let everything go. Now the grass, the common area, the pool is green. Nobody's taking care of anything, right? And what does that do? It impacts value, right? On top of the short sales or the REOs that are taking place, right? So for those of you that may not know this and who don't stay on top of things, this is one of the issues that's happening down in Florida with condos, right? And I'm talking about special assessments and HOA issues, right? Not new build per se, but I'm talking about HOA where because of the new laws based on that tragedy that happened with that building that collapsed, right? So now there's requirements for the buildings to be inspected and have meet up to a certain code. And the HOAs for those buildings are giving a certain amount of time to get the property and the building up to code. Repair all the cracks, foundation issues, anything. Structural engineers got to come in and do a report and do the repairs. Well, there's a fee, there's cost to all of that. And if you don't complete it, the city or whomever the municipality, maybe it's either fines the HOA or tags it and say, hey, this is, you got to vacate this building because it could come down, or, right, they may condemn it or whatever. You got all these things, right? So there's money that needs to be fronted to get all this stuff done. Well, again, if your HOA was already, say, $100, and now you got to pay for this, and now your HOA goes to $500, or they do one-time special assessment, and I've seen some where, tens of thousands of dollars, not just a couple of $1,000, tens of thousands of dollars are being special assessed to every owner in that building. And some of these people don't have the money, right? We know Florida tends to be more of a snowbird retiree kind of area. There's a lot of retirees down there that are on fixed income, that are living in these units. And if you tack on an additional assessment, plus you're going to increase their HOA monthly fee from $100 to $1,000 or $1,500 or whatever it is, it just blows them out of the water. They can't afford it.
Yeah.
So all these people are trying to get out, right? And as they say in a fire, if there's only one door, you got 100 people, and everybody's trying to get out at the same time. That's a problem, right? And that's what's happening with some of these, where people are trying to put them on the market, trying to sell because they don't have the means to pay it. And obviously that devalues, because now everybody that's potentially a buyer, you and I know this, and anybody else that's in that market or any agent that's in that market probably should counsel their buyers and say, yeah, this is what's going on, right? You got to disclose to the agent, hey, these are the special assessments. This is this is what's happening with this building, right? You have a fiduciary duty as a real estate agent to kind of disclose that and let the potential buyer know. If they don't know, well, everybody's going to shy away from it, right? So if there's less buyers, more sellers, right? Supply and demand, basic economics. That's what's happening. That's people are dropping their prices because they got to get out. And then, it's like a falling knife. Nobody's catching this falling knife right now. Right.
Yeah.
And we know the issues with the hurricanes and so forth that are impacting insurance costs. So these HOAs, not only do they have to do these repairs, but their insurance costs are going up too. And that gets split, and that's shared within the community on the HOA fees and monthly fees. So now basically kind of has a spiral effect, right? So that's what's happening in Florida right now with condos, right? And again, we started with new builds, but as it relates to the impact of HOAs and PUDs. And so builders kind of see some of these things, right, from experience. So that's why they're shying away from it, right? So this goes to working with people that have been around like us, that have seen these cycles to know, hey, this is a good time or this is not a good time, or where is the right place, and what are you trying to do, and what's the purpose. I mean, if it's a second home or a vacation home, I guess some people could, if they have the means and they don't mind necessarily, okay, right? But as long as you know what you're getting yourself into, right? But having experienced people like us to kind of help you along the way and kind of guide you, and having this experience to kind of point out the potential pitfalls. We talked about something else as it relates to another creative method that's happening out there, and some of the things that are coming up with that, right? So I don't want to touch on that necessarily, but back to new construction and some of the issues that builders or some of the guardrails that builders have put in, or they look out for because of some of the things that have happened in the past, right? So, and I know you're working on a couple of properties that are condos, and you have the PUD and the So you want to talk about that, or as it relates to any of the other new construction? How much new construction is happening in your market? Got a lot of builders out there?
Yeah. Denver area, out to the east and south, there's a lot. So I was going to mention a couple things. One option, if there's a builder that doesn't allow rent to own, another option is owner financing, seller financing, because it's not renting,
Yep.
That's a possibility. That's not what we focus on, but that is a way around that. Then the other thing,
if you already own it, right? So let's say you get a listing from an owner that owns a property free and clear and wants to sell it on seller finance to somebody, then yes, right? The new person coming in, buying the property, making the payments to the seller, because the seller became the bank in that transaction, then they took ownership. So yes, that is an owner-occupant transaction, right? So they're buying it, right? But if we're stepping in as the buyer necessarily, right? Could we potentially do something like that? Potentially. Right? Potentially we could do it like that. But the builder doesn't see us that way yet, right? Because they know we're not going to occupy it. So in the A to B, meaning the builder is the A, we're the B, and then the rent to own seller individual that's that we're selling it to is the C. In the A to B, we're an investor.
Yeah, we're going to get an investor loan.
Right. If we were already the B to the C, then we could say, okay, seller financing is a sale, right? And it is a sale from the A to B, but we don't intend to occupy as an owner occupant, right? And that's where the restrictions come in and say, well, you're going to occupy it. Well, we buy it, or investors buy it, generally in an LLC, right? So that's the big flag. It's like, well, you're not going to occupy. Why are you buying it in an LLC, right? So these are things that come up. So yes, to your point though, if you do have a situation like that where the PUD or the HOA restricts investors, if a seller already owns it and has the ability to sell it on seller financing, and the buyer becomes the owner, then that is definitely a way to kind of do that transaction, right? Yeah. And then that also helps in situations where there are some restrictions. So from a lending perspective, FHA and Fannie Mae and Freddie Mac have certain rules as it relates to investor concentration, or if it's an approved project when it comes to a HOA or a PUD, right? So, but if you're getting seller financing, then there is no need to meet FHA or conventional, as long as the seller financing has a 30-year timeline, or even a 10-year timeline. I guess somebody could do a 10-year with a balloon and give it enough time to see if things have changed, and then potentially with the option to extend, and I don't know, a year to year, or every 5 years, or something to that effect could be written in the contract or the agreement. So yeah, that's an option. But these are a little bit more advanced strategies, and again, working with people that are in the know, they understand these things and kind of explain it to people. The majority of traditional agents aren't experienced in that. They have never done one. They don't. If you ask them about that, it's maybe over their head. Brokers don't really teach this stuff because they don't want to get outside the box. They want to do just traditional because No, they don't want any potential additional liability that it may bring to them. So these are things that people either have learned on their own, have done it, time, experience, and been through the different cycles. Selling on seller financing and all this, anything that's non-traditional, has always been around, right? It just doesn't seem like that. Let's say prior to the rates going up, but while we had the boom, right? Nobody really had to do this or think outside the box.
Yeah.
Because you can get financing for 3% and everybody qualifies at 3%, right? It's easy to qualify when the rates are 3%. Well, now that rates are different, higher, then less people qualify. You have to kind of think a little bit differently, and sellers will still want to sell. I know we're talking about this lock-in with the rates, but people still got to sell, right? You got clients that are trying to sell, like, so it's not everybody that says, oh, well, I'm stuck here and I can't move, right? Or
Right.
I'm stuck here and I don't want to move, right? But you have people that have to move, right?
Right.
There are sellers out there, hey, have to sell for whatever reason that may be, life event or so forth, right? So not everybody can or wants to stay where they are just because of rate, right? So sometimes the rate isn't worth it, right? I think I saw somebody post and say, hey, if the only thing you like about your house is the rate, call me, right? Because if you outgrown it or you got to be closer to family, friends, job, and you got to go or you're getting job relocated, doesn't matter the rate, right? You got a life to live.
Yeah.
Your life doesn't revolve around the rate. And unfortunately, people look at it that way, but sometimes it's just not reality.
Yeah. Divorce, death, diapers, job transfers. There's all sorts of reasons why people have to sell.
I like those 3 Ds: divorce, death, diapers.
Yeah. I heard that the other day. I'm like, divorce and death. Oh, diapers. That's a good one. Yes.
Yeah, I like that.
Need another D for like a job change.
Displacement.
Depromoted. I wanted to point another thing out. I get calls here and there from people that they've already locked up a new construction home. They've picked out those finishes, those upgrades, and they're like almost there. And then the lenders like didn't catch something or something changed. They're like, oh crap, can you save us? So that's actually a pretty good situation because we know they're pretty close. Maybe something very big came up and they're not going to fit our program, but if they've got money to put down on that house, that could be a good situation where we come in and save them. Here we come to save the day.
So. That's right. And in that situation, the builder's going to be happy because they're going to get paid, right? They're like, oh, well, instead of it falling apart and this deal not closing, at least we have an option here, right? And again, it'll be back to, hey, having a discussion with that builder, say, hey, will you let us step in as the investor and buy it instead of them since they don't qualify anyways?
Yeah.
Right. So now, could they say no? Sure, they could say no, right? But at least we're having that conversation if you're in that situation, because when you decided to buy that house, that was 9 months ago, and now that it's almost closing, the lender pulls a new credit report, double checks and calls your job to make sure you're still there. You're still making the same amount of money. You didn't quit your job, transferred job, took on new debt. You didn't get that new Tesla in between there, and they qualified you when you didn't have that Tesla payment, right? And now you don't qualify, and right before you're about to close. Now you got to go scramble, or your agent, if you're an agent, you've been. Agents know this. They've experienced this when you had a client, even though you may have told them, hey, don't take on new debt. Don't go checking your credit. Don't go do this. Don't go do that. People still do it.
Yeah.
Right? Don't go moving the money around for the down payment because you got to send it the day before closing. And now you transfer it to this account and it went to that account. And then you send it to your cousin or brother and you lend it to them for a period of time. Then now they're sending it back to you. And now the lender's asking, where did this money come from? Well, where's the money? Or, oh, we see this large deposit. Who's this person that sent it to you? Isn't it eligible? Oh, no, I had this side deal with this person and whatever, right? So the lender's going to still source those funds. And if you did all kinds of crazy stuff in between, this is when deals start to fall apart.
Yep. It happens.
Yeah. And people don't even realize that this happens a lot more often you know, because people are living their life in 9 months, 12 months, a lot of stuff happens, right? So that's why we try to shy away from a situation like that. We want something that, hey, we can close in 30 days, 45 days. That way we don't, that gives us less time for things to evolve and change, and then keep everybody on board with what's happening, right? We don't want to put anybody's money at risk. If you're putting up your money at risk, we don't want you to lose it, right? So we're trying to keep you from getting yourself into trouble where you're going to end up forfeiting monies to the builder because, you know, stuff happens. So,
yeah.
Any final thoughts with this?
No, I think I covered everything I thought of.
Yeah, so it is an option. So the final answer is it is an option. There are some qualifiers, right? There's some caveats to this based on the builder, what the timeline is, what your individual situation is, and so forth, right? So, but for that reason, work with people that know what the heck they're doing, been around, understand the dynamics, understands the whys of why things are what they are, and how to, you know, kind of maneuver through this, and kind of give you either an option to say, hey, this is probably not a good time for it, right? Because sometimes we have to say no to people.
No.
Right? I mean, that's just, unfortunately, that's the reality, right? Because we want them to succeed. We don't want to set people up to fail, right? Unlike other rent-to-own providers, no, they're not really all that. They don't really care all that much whether you succeed or fail, right? We're vested in the aspect that you're going to succeed because that's just better business.
100%.
All right. Well, any final thoughts? That's it?
We're good.
All right. If people want to get a hold of you, talk to you, and kind of run a scenario by you, they have a new bill that's fallen out. You know, they took out the Tesla payment and now they don't qualify. How do they get a hold of you?
Yeah, just go to linktree.com or Linktree, partner with James Brown. Linktree's a good one. Anyway, go ahead.
Yeah. Look up James on Facebook. He's on Facebook. He's on Instagram. I know he gives his link trees on Instagram, Facebook. So he's out there. He's part of several Facebook groups out there with agents as an EXP agent. So reach out to him if you got a scenario, or you can reach out to me. I am at Mr. Rent-to-Own Homes on YouTube, Instagram, TikTok, and X, or former X. Or former X, or whatever it's called these days. We'll know what it's called next week. Or you can go to our website. That's www.rent2ownhomesus.com and put your information in there. Once you submit your information, we'll reach out to you and have a potential conversation about what your scenario is, how we can help you, how maybe we can't help you, right? So, or in the bio, you can reach out to me. I have a link tree on there, my email address as well. You can reach out to me, or on the socials, you know, DM me and so forth, and we can get in touch. All right. Until next time, thank you very much for joining us today. I am Mr. Rent-to-Own Homes, Dominic Danino. See ya.